The Bank of Canada just admitted something that should scare every Canadian homeowner. They no longer know what happens next. And if your mortgage renews in the next 12 months, that uncertainty could cost you thousands of dollars because right now, Canada is trapped. Inflation is sticky, oil prices are surging again, and the economy is slowing down. Fixed mortgage rates are quietly climbing, and for the first time in this cycle, the Bank of Canada publicly admitted that both rate cuts and rate hikes are still possible. Think about that. After the fastest rate hiking cycle in modern Canadian history, they still don't have control. Let's go. Over 1.8 million Canadians are heading into mortgage renewals right now. Some families are about to see their payment jump $500, $800, even $1,500 a month, and others are going to use this exact market to quietly put themselves years ahead financially. The same country, the same economy, the same interest rates, but completely different outcomes. And the difference has almost nothing to do with your rate. It comes down to whether you understand what's actually happening before you renew. Because most Canadians, they still think mortgage rates are controlled by the Bank of Canada, and they're not. At least not the rates that matter most anymore. The bond market is now driving fixed mortgage pricing. Lenders, they're repricing risk in real time. And the people sitting around waiting for one more rate cut might be walking straight into even higher fixed mortgage rates instead. That's the trap right now. People think they're waiting to save money while the market quietly moves against them. So let's talk about what this week's announcement actually means. The Bank of Canada meets June 10th, and bond markets are pricing a 97% probability that they hold. Translation, no change. The policy rate stays frozen. But here's what the market is actually afraid of. Markets are also pricing in a 15% chance of a rate hike by mid-July. And that doesn't sound like much until you realize that 6 months ago, markets were betting on rate cuts. The entire narrative has flipped from when will they cut to will they have to hike. That shift is massive, and it's happening because something most people aren't even paying attention to. It's the inflation. The Bank of Canada's own forecast released in April shows inflation climbing to 3% in April before dropping to 2.5% in June. That's not comfortable for the BOC because 3% is 50% higher than their target rate of 2%. Energy prices are the culprit here. Oil is back over $90 a barrel because of the Middle East conflict, and that flows through directly to gas, groceries, shipping, heating. They all rise. So the bank is in a generally impossible spot. They cut rates and they risk inflation, reigniting and the dollar falling further, hold rates, and the economy keeps slowly breaking down. Canada's GDP contracted last quarter, so we're technically in a recession. Job creation, it's slowing, and household debt is at record highs, and delinquencies, as small as they are, they're climbing and they're to levels that we haven't seen since 2008. So this week's announcement, it won't fix all of this because the bank simply can't fix it. The real action is happening in the bond market. 5-year Government of Canada bond yields are currently at 3%. That's what drives your mortgage rate, not the Bank of Canada's policy rate, not the media headlines about this week's decision. The bond market drives fixed rate mortgages, and bond traders have already priced in what they think happens over the next 5 years. They think rates are either staying here or going higher. They don't think they're going lower. That's why 5-year fixed mortgage rates are currently sitting in the mid 4%, not 3.8, not 3.5, mid 4s. And forecasters are predicting by the end of 2026, those rates could drift slightly higher. That's another 40 to 75 basis points higher. So if you're waiting for rates to drop before you renew, you might be waiting in the wrong direction. Here's what Scotiabank just forecasted. 3 rate hikes in the second half of 2026. Not cuts, hikes. TD is signaling the same thing. Markets have priced in at least 1 rate increase this year. National Bank, which is usually conservative, admits that inflation anxiety could force tightening in early 2027 if things don't cool down. So the consensus has shifted from lower for longer to higher coming. And that changes everything about renewal strategies because if you're renewing in the next 6 months, you're locking in before a potential hike cycle. If you're waiting for just one more cut, you might get a surprise in the other direction. But here's the thing that really matters. This isn't about Bank of Canada's decision this week because the market has already moved. 5-year fixed rates have already climbed almost 40 basis points since earlier this year. That happened before this week's announcement. That's bond markets reacting to energy prices, inflation fears, and geopolitical uncertainty. So when the bank announces their decision this week that they're holding at 2.25, most people will hear, okay, rates aren't moving. But what actually happened is the market already moved your mortgage rate without them doing anything in mainstream media. That's how the system actually works. The policy rate and the mortgage rate are increasingly disconnected. One person renews at 4.2, another at 4.5. Same week, same economy, same Bank of Canada rate, but completely different outcomes. And the difference is timing and understanding, because variable rate holders are a different situation entirely. If you're on a variable, your rate is tied directly to the bank's policy rate. Right now, you're roughly 4%, depending on what your lender's spread is. If the bank stays at 2.25, you stay where you are. But if Scotiabank is right about their 3 hikes in 2026, your variable rate is going to climb significantly. And here's the trap. Variable rate holders are about to start renewing into their fixed rates, and they're going to lock in at 4.4, 4.3, 4.5, whatever the market's offering when they renew. And if rates are climbing, they're locking in on the way up. Meanwhile, people who renewed into fixed rates last year are locked in at like 3.6, 3.7, enjoying massive stability. That gap matters. Over a 5-year term, the difference between 3.75 and 4.5% on, let's say, a $500,000 mortgage is roughly $600 per month. That's $36,000 over 5 years, all because of timing. So what should you actually do before the announcement this week? First, if your renewal is in the next 90 days, act now, not after the announcement, now. The bond market has already moved. Lenders have already repriced. Waiting for this week's announcement changes nothing. Second, understand your options. Are you variable? Are you fixed? If you're variable, you need to calculate your break even on switching to a fixed. Switching to a 4.9 or a 4.3 might not make sense, but switching when you're at a 4.5 and fixed is 4.09 suddenly makes sense. Third, if you're fixed and coming up for renewal, don't let your lender send you a renewal offer and assume that that's the only option. Shop the market, talk to me, get rate holds. Rate holds, they're free. They lock in pricing for 120 days, so use it. Fourth, understand a prepayment strategy that I've shown in other videos. When you renew, if you move from a higher rate to a lower rate, you can capture that difference, pay the lower minimum payment, but redirect the difference to the principal. That's how you shave years off of your mortgage without refinancing. And fifth, stop waiting for the Bank of Canada to rescue you with cuts. They can't. Inflation is sticky. Energy prices are fucked. The economy is fragile. They're trapped. So the only thing you can control is your own mortgage strategy. Are you switching or staying? Are you going fixed or staying variable? If you switch, are you capturing the rate difference and redirecting it to the principal? If you're refinancing, are you being strategic about extending AM versus stretching yourself thin? These are the decisions that actually matter, not this week's announcement, because by the time the announcement comes, the bond market has already decided. Your mortgage rate is already baked in. The question is whether you know the game well enough to win it. One more thing, the stress test. Your ability to qualify depends on the stress test rate. Right now, it's the higher of 5.25 or your contract plus 2%. So if you're renewing at 409, you're stress tested at 609. That's tight. That's why some people who could have qualified 2 years ago are getting denied now. Not because they make less money, but because the stress test has gotten more aggressive as rates have climbed. So if you're renewing and your broker says to you that you don't qualify, ask them to shop alternative lenders. Different lenders have different stress test approaches. Some are tighter, some are more flexible. Shop it, because the difference between qualifying and not qualifying is knowing the system and having a broker in your corner. So here's the bottom line. This week's BOC announcement, it's a done deal. It's priced in. Don't wait for it. The bond market moves faster than central banks. Fixed mortgage rates are anywhere between 4% and 4.5% right now. They could drift higher before the end of the year. Some forecasts see it as high as 4.9% by December. Variable rates are stable, but vulnerable to hikes in the second half of the year. Your renewal decision matters more than the Bank of Canada's decision. And your mortgage strategy, whether you're capturing rate differences, using prepayment privileges, or accepting relief, determines your financial outcome. Not luck, not the BOC, you. When you're done with this one, check out my last video where I broke down the 5 mistakes to avoid when refinancing. I'll see you there.